Hey everyone, welcome back to the channel. Today, we're diving deep into a topic that might make some of you a little nervous: stock market crashes. But stick with me, because understanding the past is one of the best ways to prepare for the future. We're going to look back at 150 years of financial history to uncover the timeless lessons that every investor needs to know. So, what exactly is a market crash? Generally, it's defined as a rapid and often unanticipated drop in stock prices. Think of a 20% or more decline in a major market index like the S&P 500 over a couple of days or weeks. These events feel chaotic, and in the moment, they can be terrifying. But history shows us they are a recurring feature of the market cycle. Let's start our journey way back in 1873 with the Panic of 1873. This was a global event sparked by the collapse of a major bank in Vienna, which then spread to America. The overexpansion of railroads, fueled by massive speculation and debt, created a bubble. When the bubble burst, banks failed, the New York Stock Exchange shut down for 10 days, and a long depression followed. The first big lesson here? Speculative bubbles, often fueled by new technology, in this case, railroads, are a classic prelude to a crash. When excitement overtakes fundamentals, be cautious. Fast forward to one of the most famous crashes in history, the Wall Street crash of 1929. The Roaring Twenties was a decade of incredible economic growth and optimism. People were borrowing heavily to buy stocks, a practice known as buying on margin. The market seemed like a one-way ticket to wealth, but on Black Tuesday, October 29th, the market plummeted, wiping out fortunes overnight. This crash triggered the Great Depression, the longest and most severe economic downturn in modern history. The lesson? Leverage is a double-edged sword. It can amplify your gains, but it can also magnify your losses catastrophically. The widespread use of debt in the market made the crash infinitely worse. Next up, let's talk about Black Monday, October 19, 1987. This was a truly shocking event. The Dow Jones Industrial Average dropped nearly 23% in a single day, the largest one-day percentage drop in its history. What's fascinating is that there wasn't a single clear trigger like a bank failure. Instead, a combination of factors, including international tensions, a falling dollar, and, most importantly, new computerized trading strategies, created a perfect storm. These automated programs were set to sell automatically when prices hit certain levels, creating a cascading effect of selling that spiraled out of control. The key takeaway? Technology and financial innovation can introduce new, unforeseen risks into the system. The very tools designed to make markets more efficient can sometimes accelerate a panic. Now let's move into the modern era with the dot-com bubble burst in the early 2000s. The late 90s saw a massive speculative frenzy around internet-based companies. Investors poured money into any company with a "com" in its name, often with little regard for profits or even a viable business plan. It was the new economy, and old valuation metrics were said to no longer apply. Sound familiar? It's the same pattern as the railroad boom of the 1870s. When the bubble burst, legendary companies like Pets.com went bust, and the tech-heavy NASDAQ index lost nearly 80% of its value over the next 2 years. The lesson is timeless. Fundamentals always matter. Hype and narratives can drive prices in the short term, but eventually, a company has to make money. And, of course, we can't forget the 2008 global financial crisis. This was a crisis rooted in the housing market. Complex financial products called mortgage-backed securities, which were bundles of home loans, were sold to investors around the world. Many of these were subprime loans given to borrowers with poor credit. When the housing bubble burst and homeowners began defaulting, the value of these securities plummeted, causing massive losses for the banks that held them. This led to a credit crunch that froze the global financial system and sent the world into a deep recession. The lesson from 2008 is about interconnectedness and hidden risks. A problem in one corner of the market, like subprime housing in the U.S., can cascade through the entire global system in unpredictable ways. Complexity can hide extreme risk. So, after looking at all these historical crashes, what are the big, overarching themes? First, market crashes are a normal, albeit painful, part of investing. They have happened before, and they will happen again. The key is not to be surprised by them. Second, human psychology is a constant. Greed drives bubbles, and fear drives panics. The emotional roller coaster of watching your portfolio shrink is real, and it often causes investors to sell at the absolute worst time, at the bottom. Third, leverage or debt is like pouring gasoline on a fire. It makes good times better, but turns bad times into disasters. So what's the most important lesson for us as individual investors? It's this. Despite every crash, the market has always recovered and gone on to reach new highs. Always. For long-term investors, a crash is not the end of the world. It's a temporary sale. It's an opportunity to buy great companies at a discount. Panic selling locks in your losses and prevents you from participating in the eventual recovery. The best defense against a crash is a solid plan you create during calm times. Know your risk tolerance, have a diversified portfolio of different assets, and most importantly, have a long-term perspective. Don't check your portfolio every 5 minutes. Don't get swept up in the hype or the panic. Focus on what you can control, your savings rate, your diversification, and your own behavior. By learning from the mistakes of the past 150 years, we can become smarter, more resilient investors, ready to navigate whatever the future holds. Thanks so much for watching. I hope this historical perspective was helpful. If you found value in this video, please hit that like button and subscribe for more content. Let me know in the comments which market crash you find the most fascinating. Stay safe, and I'll see you in the next video.